Hi everyone. This is lecture 4. So this is going to be we are going to be covering lecture 4 in this video. If you remember last lecture we covered utility, the different forms of utility like marginal utility, total utility, average utility, and we also talked about the elasticity of demand and elasticity of supply. Today we're going to focus more on the producer side or the business side, and that's going to cover the different types of market structures, the different business forms, and it's also gonna talk about the different types of cost that a producer or a business faces or incur when they basically produce goods and services. Okay, so we're going to look into that, and this is very important because they need to understand what their costs are and how they can reduce these costs in order to make money or in order to make profit. So to start off, we are going to talk about the three main different types of business firm organization. So if let's say I as an individual want to form a business and start producing goods or services, then I can organize my business in one of these three forms, okay, depending on what I'm producing, depending on the type of products, depending on the number of people involved in the transaction, depending on the amount of investment. So it depends on a lot of things, but basically when someone or when an entrepreneur decides to create a business to produce goods and services, they can form or organize their business into three different forms. The first one is called the sole proprietorship. Okay, so this is one of the most simplest forms of the business, and it has only one owner. So when we talk about a sole proprietorship, the business is owned 100% by one person or by one entrepreneur. There's no other partners involved in the business. Okay, the owner himself, at times, the owner himself can be the only employee of the business. Okay, like let's say I open up a CPA firm and I provide tax services and I do not have any employees, but I am the only one preparing taxes for my clients. In that case, I am providing accounting services and I'm forming a sole proprietorship where I am the only employee and I provide the services to my customers. So that's a sole proprietorship, but there are times when a sole proprietorship can have employees. For instance, I may own a gas station, which is a business that provides gas and convenience store products, but I may have some employees working in the convenience store. So but that is still a sole proprietorship. Okay, it's a very simple form. The owner or one person supplies all the assets of the business. Basically, whatever assets the business has or whatever assets that are bought for the business, those are bought using the funds of the one owner. Nobody else is there. Or nobody else is contributing in this business. Only one person who is the owner basically contributes all the investments to buy the assets of the business. In terms of the number of businesses in the US, approximately three-fourths or 67% of all the businesses in the US are sole proprietorship business. So you can see there are a lot of or a large number of small businesses within the United States that are basically that has only one owner, and they are probably localized in an area offering goods and services to local customers. Okay, and most of these businesses start off at this form as they are a source of creativity. Usually, I have a passion for gas station and I go and buy a gas station, or I have a passion for tax services, or I have a passion for clothing boutique and I go and open up a boutique store. That is a sole proprietorship. And majority of the business in the US, 67% of the businesses are organized under sole proprietorship. So one some of the advantages of this type of business form are it's very easy to organize and form. So only one owner. You do not have to deal with a lot of partners. One person can go and file it with the Secretary of State and form the corporation, and it's a very simple basically it has a very simple method or simple model, this type of business. Disadvantages include the owner, or who's the basically the owner of the business, faces unlimited liability for all the debts and judgments against the farms, right? So let's say against the gas station, I take a loan from the bank. That loan, I, as an owner, have to provide unlimited guarantee for that loan. And as a result, if that loan goes bad, I, as the owner, will be responsible for that. And I'm the only one who's going to be responsible for that. There's nobody else. So any type of debts, loans, or judgments against the business will eventually come to the owner because he's the sole owner or sole owner of that business. Okay. Sometimes personal belongings of the owner can also be seized by the banks if the debts are in default. So that's one of the disadvantages of sole proprietorship. We then move on to the next type of business form, which is called a partnership. This is also similar to sole proprietorship, but a little bit bigger in scale. Basically, there are two or more partners in this type of business. So let's say me, John, and Blake. The three of us come together to form a business or to form a grocery store. Um, so that is a partnership where there's more than one owner. There's two or three or more. Usually between 2 to 5 partners in this type of businesses, and in this type of our business organization, which is also known as partnership, each of the partner or each of the owners right in the business are specifically outlined in terms of the business operation, termination, and profit distribution. What does that mean? That means that, let's say, if we buy a business and if we start, if let's say John, Blake, and I buy a business, and we start operating the grocery store, so the business will specifically outline that I will be responsible for buying inventory, John will be responsible for doing the advertising, and Blake will be responsible for payroll and hiring individuals. So that's how business specifically will outline the responsibilities of all the owners. It will also say, like, at what point you will terminate the business and how you will terminate the business. And it will also discuss how the profit will be shared among the three of us. Let's say I will get 30%, Blake will get 40%, and John will get another 30%. So it will be specifically outlined depending on the negotiation between the partners. So advantage of partnership is basically it is a pooling of a diverse talents needed in the firm. Basically, there's not only one person. There's two, three, four, or five partners out there, and different people have different ideas. They can come up with more creativity, more efficient ideas that can make the business more successful, right? For instance, a person who is good in sales can team up with a person who is good in production, so that would be really awesome, right? Because the salesperson will be bringing in clients, and the production person will be basically producing high quality products, and they can sell those products to the customers. So there's a pooling of diverse talents. One of the disadvantages of partnership is basically these forms of businesses face the same liability for debt, loan, and judgment as sole proprietorship. So if a loan goes wrong, all the two or three partners will be equally liable for the default of the loan, and they may have to personally bear the liability. So that's one of the disadvantages of partnership. And the third type of business form or a third type of organization that a business can organize into is basically called a corporation. These are basically huge businesses like, Samsung, Walmart, Intel, HP, Dell. These are huge companies, and they are all organized under a corporation. Okay, so a corporation is basically a legal entity that owns assets as well as liabilities, and the entity is owned by many stockholders or shareholders. Even today, I can go online and buy shares of Dell, and then basically from that share I am getting return, and when I buy those shares I become a stockholder of the company. So anyone can invest in the company and become part owner of the company. um, Advantages of these type of companies are basically there are a lot of sources of funding coming to the business, right? um, you know a lot of people can invest in this business, so a lot of money coming into the business. Also, another advantage is the stockholders or the shareholders are not liable for the judgments or the loans. The company's liabilities are the company's liabilities. It will not go to the stockholders. So that is a great advantage of this type of companies, because it's limited to the company. If the company's loan defaults, the company will fail, but nothing will happen to the stockholders or shareholders. They are protected. Also, the corporation can raise large amount of capital because a lot of people can invest in this type of businesses, and they usually do that by issuing stocks to the public, which gives a return to the public as well, right? Now, disadvantages of this type of business organization is it's very difficult to organize this type of business, and it's often a very complicated process. You probably will have to hire attorneys or CPAs to form a corporation because it's very complicated. Um, Now, in terms of output, the number of goods and services produced in the US, majority of the output comes from corporations. Although we have a lot of sole proprietorship, but they are very small in size, so the number of output is very less. But corporations, they are huge, so they produce a large number of goods and services, and therefore majority of the output is accounted from the corporations. We also learn a little bit about income statement. You're going to learn if you take an accounting class. This is something that will be bread and butter for you. But again, I just wanted to give you an idea how income statement, because we are talking about businesses, and income statement is very important for a business for them to see how they are doing. Okay, so it basically is a statement that tracks your sales and the operating costs that you're incurring as a business over a certain period of time. Okay, and it also tells you how much profit you made at the end of the year or at the end of the quarter. This is a very useful financial statement that will help the businesses to make future decisions and also will help them to budget in the future periods. Okay, and this is over a period of time. So let's say over 12 months, over a year, or over 6 months. We look at the sales, the costs, and profit over a period of time. So the way we do it, the way we look into an income statement is basically we usually will have total revenue on the top. So total revenue is basically your total sales, how much you're selling, and that is calculated basically price times the quantity sold. That's how you will get total revenue. Then you will have the cost of goods sold. Let's say the cost to buy the raw materials, those are the cost of the labor. Those will be subtracted to give you the gross profit. And from the gross profit, you will subtract all your operating costs, and then eventually you will get the net profit or profit. So that is how the income statement is calculated. Cost of goods sold, these are basically the cost of your raw materials to make the product, or the cost of your labor or the salary that you paid to the labor or workers to make that good. Those will go under cost of goods sold. Operating costs are costs such as utilities, electricity bill, water bills, rent, insurance. These are all your operating costs. So you subtract that from your gross profit to get your final net profit. Now, this can be a loss too. If you are not making money, you will make a loss. So, it can be net profit or net loss. And that is how you look into an income statement. So, moving on, that is how we will calculate profit. Basically, we will look into the total revenue or total sales minus the total cost that will give us profit or loss. Okay. Now, I have told you how to calculate total revenue. It's basically price times your quantity you sold in the market. The seller, when they are selling the products, they will definitely look into marginal revenue. This is very important for them to determine the profit maximizing level of the output. The businesses need to know at what revenue level they can maximize their output, right? So the way marginal revenue is defined is basically given by, and we did this before as well. So marginal revenue is given by change in total revenue divided by change in output. Okay, most markets have downward sloping demand curve, which means firms have to lower prices in order to sell more output. We know that, right? In most markets, if we want to sell more, we have to lower prices, so demand will go up, and then we can sell more goods to the buyers, right? Thus, as output increase, as we increase output, marginal revenue will decrease because we are lowering the prices, right? So let's do an example. Just look at this. All right. So let's go. Uh, so this is given to us. Let's say this is given to us. We are given with quantity sold and we're given with the price. Okay. So if you see when the price is $10, nobody is going to buy the good. When the price falls down to $9, one person will buy it. When the price falls down to $8, 2% will buy it. When the price goes down to $7, three people will buy it, and so on and so forth. Okay, so that's the table. This is given to us, the price and the quantity sold. Now we are asked to calculate the total revenue. We are asked to calculate the total revenue and the total. Sorry, had some technical difficulties, but again, going back to the same table, when the price is 10, the zero quantity is sold. When the price drops to $9, one item is sold. When the price drops to $8, two quantity is sold. When the price drops to $7, three quantity is sold, and so on and so forth. So as you know, we know that when price drops, demand will go up and more output will be sold in the market. So this information is given to you. Now, based on that, we ask you to calculate the total revenue and marginal revenue. Now we know how to calculate total revenue. This is equals to price times quantity, right? Remember, total revenue is equals to price times your quantity. So when your price is 10, you sell 0 units, so your total revenue is 0 because you're selling 0 units. When you're selling 1 unit and your price is $9, it's 9 times 1, your total revenue is 9. Then 8 times 2 is 16. Then 3 times 7 is 21. Then 6 times 4 is 24. 5 times 5 is 25. And 4 times 6 is 24. If you see, as the price goes down, your revenue goes up at a decreasing rate, and at some point, the revenue starts decreasing. That is because the marginal revenue is decreasing as we are lowering the prices. So how do we calculate the marginal revenue? Remember, going back to the slide, marginal revenue is given by change in total revenue divided by change in output. So it's between when, let's say, when we move from 0 to 1 unit, what's the change in revenue? It's 9 minus 0 divided by 1 minus 0. So it's 9. Then we do 16 minus 9 divided by 2 minus 1. That's 7. So 16 minus 9 is 7 divided by 2 minus 1 is 1. So 7 divided by 1 is 7. Then we have 21 minus 6 is 5, which is divided by 3 minus 2 is 1 again. Then we do 24 minus 21 divided by 4 minus 3. So 24 minus 21 is 3, and 4 minus 3 is 1. Then we do 25 minus 24 divided by 5 minus 4. So 1 divided by 1 is 1. Finally, we have 24 minus 25. This is minus 1 or negative 1 divided by 6 minus 5 is 1. So we have negative 1. So if you look at the marginal revenue, it is decreasing as we are lowering the price and selling more. So even though we are selling more, the price is going down, and that's why the extra revenue that we are making from each output that we're selling is going down. And after the fifth unit, we are actually making losses. We are losing extra revenue here. Okay, so we are making extra loss here. So if the demand curve is downward sloping, we are going to have a marginal revenue curve that is as twice as steep as the demand curve. So that's the demand curve, and that's the marginal revenue curve. And this is very important for the sellers to look at when they are trying to determine at what point they want to be. Should they be here, or should they be here, or should they be here? So this is a very important factor. What they do is they look at the marginal revenue and compare it to marginal cost, and the point where marginal revenue is equals to marginal cost, that is where they want to be at, because that's where the profit is maximized for the businesses. So moving on, we're going to look into the different types of cost that a firm faces when they are producing goods and services. First one is called fixed cost. Basically, these are costs that do not change with the level of output you're producing. These are fixed payments for inputs. Okay, so let's say you're producing cell phones. Okay, now if you this type of cost will not change with the number of cell phones you're producing. So even if you're producing 10 cell phones, fixed cost will remain the same, and if you're producing 10,000 cell phones, your fixed cost will remain the same. An example for fixed cost would be insurance cost, rent expense. Like let's say I rent a space, then I pay $2,000 per month. Okay. Now I produce only 10 cell phones using that space. I still have to pay $2,000. Now if I pay 10,000 cell phones using that space, I still have to pay $2,000 per month. So that is an example of fixed cost for a firm. Okay. Now if a firm for fixed cost, even if a firm is producing zero output, still they have to pay this cost. Still they have to incur this cost. So again, if I leased a space or rented a space and I produce no cell phones at all in a month, zero cell phones in a month, but I still have to pay the rent of $2,000 because I signed the lease. So this cost will remain fixed no matter what output you produce, whether zero, whether 10, whether 100, or whether 10,000. So some examples of fixed costs are rent, insurance, property tax, if you own the real estate, etc. Okay. Now, the second type of cost that a firm faces is called the variable cost. Variable costs are basically the cost for these inputs will go up or vary with the level of your output. So usually if you produce more of a good, the variable cost will go up. If you produce less of a good, the variable cost will go down. For instance, the cost of screens, okay? If I'm producing 10 cell phones, then my cost of screens will be less. But if I'm producing 10,000 cell phones, then my cost of screens will go up significantly. So variable costs are basically dependent on the level of your output or production. The more you produce, the more cost of these inputs will go up. So examples of variable costs would be labor or workers who are working to produce the cell phones or raw materials needed to make the cell phones. So these costs, the cost of these are variable. I want to give a very simple example. Let's say you own a car. A fixed cost on the car would be the loan payment. If you have a loan on the car, no matter whether you drive a car in a month or not, you still have to pay the loan payment in a particular month. Same for insurance costs. That's a fixed cost. Whether you drive or not, you have to pay insurance costs. An example of variable cost would be the gasoline cost. Now, if you drive the car more and more, you will need more gasoline, so you have to pay for gas. If you do not drive the car at all, then you do not have to pay for gas at all. So the cost of gasoline would be a variable cost in this case. And then total cost is given by fixed cost plus variable cost. So the cost that a firm faces is given by fixed cost plus variable cost, and that is equal to your total cost. Now, these can be depicted in a graph, and that's what I want to show how they look like. So this is, let's say we have quantity produced, and here we have the cost. Okay, now remember with the number, this is 1, 2, 3, 4, 5, 6. As you more produce more output, what happens to your cost? If it's fixed cost, it stays the same, right? Sorry, this technical difficulty is killing me. But I'm gonna get it done again here. So let's say we have quantity here and we have cost here. And as I said, as we produce more output, what happens to the different types of cost? If we produce more output, your fixed cost remains the same. It does not change. It's a horizontal line. No matter how many cell phones you produce, you still have to pay the same amount of rent. So the fixed cost stays fixed. Variable cost will increase with the number of outputs. So if you're producing 0 units, you have 0 variable units. But as you produce more and more, your variable cost will go up. After a certain point, it will shoot up exponentially. Okay, so that's your variable cost. Now, what is your total cost? Remember, total cost is equals to fixed cost plus variable cost, right? So we take this and we take this and we take this. It will start here, it will go up, and then it goes up there. And the difference here is basically your fixed cost. So this, the one on the right above is your total cost. So that's how your graph will look like for total cost, for variable cost, and for your fixed cost. Okay. Now we're going to look into the different types of, like, we have to look into the average and we have to look into the total of the fixed cost, variable cost, and total cost, as well as the marginal cost. These are very important in a business decision. We need to understand the average fixed cost. We need to understand the average variable cost. We need to understand the average total cost. And then we need to understand the marginal cost to make business decisions to see where we can produce so our costs are minimized and we can make the most amount of marginal revenue, right? So that's why these are very important. So in this slide, you will see the formula for the different types of average fixed cost, average variable cost, average total cost. You do not have to memorize the slides again. These will be available to you, so you can write it in a notebook when you're taking an exam and just look at these formulas. Okay, so average fixed cost is given by your total fixed cost divided by the total quantity produced. Okay, now remember, fixed cost stays constant. So at low levels of output, where your quantity is less, average fixed cost will be high, but as you produce more and more of an output, the average fixed cost will be going down because the top number stays fixed, but the lower bottom number starts increasing, so the overall number will be going down as we produce more and more unit. Average variable cost is given by total variable cost divided by the total quantity. Okay. Now, usually average variable cost will be lower at lower quantities and higher at higher quantities as production increases, but after a certain point of time, it will increase exponentially. Average total cost is given by your total cost divided by total quantity. It is also given by, there's another formula if you see, average total cost can also be calculated by adding average fixed cost plus average variable cost. Here it says average total cost, but it should be average fixed cost plus average variable cost. So that's how you can also calculate average total cost. Finally, we have marginal cost. Remember the definition of marginal cost. It is the extra cost that businesses will incur for producing one extra unit of output. Okay, so let's say if we are producing 10 cell phones, now we decide to produce the 11th cell phone. What is the cost of that 11th cell phone? That is known as the marginal cost. So marginal cost is given by change in total cost divided by change in output. That's the formula for marginal cost. And this is again very important because we want to compare marginal cost to marginal revenue so that we can find out the profit maximizing point. So we will do a look into an example now. We will have a table given to us and we will look into how we can calculate these, because in the exam or in the homework, you can have a similar type of situation. So let's go to this one. This is, apologies. So let's go to this one. So this is given to you. Okay. You're given with the quantity and you're given with the total cost. Now, let's first focus on your total fixed cost and your total variable cost. Okay, let's first focus on these two to calculate. Let's think when the business is producing zero. Okay, the total cost is 110. Remember, when we are producing zero units, we do not incur any variable cost, and if we are producing zero units, the fixed cost still stays the same. So even if we are producing zero units, we still have to pay the rent, right? So that's a fixed cost. So all of it is fixed cost, but right now there is no variable cost, so that's zero. Or think about another definition of total fixed cost. Fixed cost will remain the same no matter what the level of output is. We already determined fixed cost is 110. It will not change with the level of output. So Now we find out the total variable cost. Remember, total cost is equal to total fixed cost plus total variable cost. We have the we have total cost, we have total fixed cost. Now we calculate total variable cost, which is basically you take total cost minus total fixed cost. So 170 minus 110, this is 60. 220 minus 110, 110. 260 minus 110 is 150. 320 minus 110 is 210. Then 420 minus 110 is 310. And then finally 560 minus 110 is 450. If you see with the amount of goods you're producing, your total variable cost is increasing because you are incurring more cost for raw materials and labor. That's why your variable cost is going up with the number of outputs you're producing. All right, so now we have total fixed cost, we have total variable cost, and total cost. Let's find out marginal cost. Again, remember it's the change in total cost over change in quantity. So we look into that. Here, what's the change in total cost? Change in total cost is 170 minus 110 divided by change in output is 1 minus 0. So this is $60. Okay, then the next one is 220 minus 170. Change in total cost, 220 minus 170. And then change in output is from 2 to 1, right? Because we move from 1 to 2. So change in output is 2 minus 1. So 50 divided by 1 is 50. That's the next marginal cost. And remember, marginal cost is always in between the total cost of two different levels of output. Next one is 260 minus 220, change in total cost, divided by change in output is 3 minus 2, so this is 40. Same way, now we do 320 minus 260 divided by 4 minus 3, that's 320 minus 260 is 60, divided by 4 minus 3 is 1, so 60 divided by 1 is 60. Next one is 100 divided by 1, which is 420 minus 320 divided by 5 minus 4. So 100 divided by 1 is 100. And finally, we have 560 minus 420, which is 140 divided by 6 minus 5 is 1. So 140. So we now see marginal cost. And if you see at after some point, marginal cost decreases, but then it shoots up. It increases significantly. Now we calculate the average fixed cost. Okay, now average, we will not have any value of the average when the quantity is zero because if you divide anything by zero, it's going to give you infinity or undefined. So there's not going to be any average if you're not producing anything at all, right? So we don't calculate average when the quantity is zero. We're going to start from one. Okay, so when we are producing 1 unit, the fixed cost is 110. So average fixed cost will be, remember, total fixed cost divided by quantity, which is 110. Total variable cost divided by quantity, which is 60 divided by 1. And to average total cost is total cost divided by quantity, 170 by 1 is 170. Next one, if we go to the next one, when we are producing 2 units, total fixed cost is 110. So 110 divided by 2 is 55. Again, total variable cost is also 110. So 110 divided by 2 is 55. And average total cost is 220 divided by 2 is 110. Next one, average total fixed cost is 110. We divide that by 3, that is 36.7. Variable cost is 150 divided by 3 is 50. And average total cost is basically 260 divided by 3, which is 86.7. Next, we go on to the 4 units of output produced. 110 divided by 4 for the average fixed cost, that's 27.5. Average variable cost is 210 divided by 4, which is 52.5. And then average total cost is basically 320 divided by 4, which is 80. I want to draw a line here so you can distinguish the differences. Then at 5 units, we have 110 divided by 5, 22. 62. Same way we are calculating 84. And then at 6 units, we have 18.3. We have 75. And we have 93.3. So that's how we're going to calculate total fixed cost, total variable cost. We're going to also use these information to calculate marginal cost, average fixed cost, average variable cost, average total cost. Notice one thing, as we produce more and more units, your average fixed cost is going down, right? The fixed cost per unit is going down because it's not changing. Whereas your average variable cost will go down first and then it shoots up. So at some point of time, your average variable cost per unit will be going down, and at some point it will start going up. Same thing happens to your average total cost, because whatever happens to your average variable cost, the average total cost will be reflected in that because it's a component of that. Average fixed cost does not change, but this change, and this is basically average variable cost plus average fixed cost. So when this changes, it will also change in the same direction. So it starts decreasing, but after some point, it starts increasing. So these are certain things, and these ultimately are reflected in a graph. That's what we're going to show. And I think the next slide also talks about that, we reflect these in different, we reflect all these graphs, the average fixed cost, average variable cost, average total cost, and marginal cost, all in under the same graph. So we're going to have a graph like this. So again, this is quantity, this is your cost, right? So your marginal cost will look like, marginal cost curve will always look like this. Okay. Then your average fixed cost curve, remember, it will go down and keep going down. So that's your average fixed cost curve. Now your average variable cost curve will be U-shaped. So your average variable cost will be a U-shaped curve like that. So remember, based on the table we looked into, if you go back to this table, average variable cost starts decreasing and after some point it starts increasing, right? So that's exactly what we see here in this graph. It starts decreasing and then reaches a minimum point and then it starts going up. Same thing happens with average total cost. It's a U-shaped curve that starts decreasing, reaches a minimum point, and then it goes up. So that's a typical graph that we are going to look into. This is marginal cost. This is average fixed cost, which is going to go down with output. This is average variable cost, and this is average total cost, which are U-shaped curves. Now, one thing to notice, if you see in the slide, we says the MC curve, the marginal cost curve, is related to your average variable cost and average total cost. So when the marginal cost decreases, look at here, when the marginal cost decreases, the average variable cost and the average total cost curve decrease at an increasing rate. Now, when the marginal cost is increasing, that's when they start increasing as well. Now, the marginal cost curve is below the average variable cost and average total cost curve. In that case, both average variable and average total costs are decreasing. When this curve, right? So when this curve is below these graphs, they are decreasing. When this marginal cost is above these curves, they are increasing. That's what they're saying. Also, the marginal cost curve will intersect the average variable cost and average total cost at the minimum point of the average variable cost curve or average total cost curve. So these are the minimum points of the curves where the marginal cost curve will intersect with the average variable cost curve and the average total cost curve. Average fixed cost is always decreasing even with increased production. So what are the goals of running a business? Again, when when a business sells products or goods and services, what are their goals? They want to provide the best customer satisfaction so that customers come back to their business and continue buying goods and services and have loyalty towards their goods and services. They want to keep their cost as low as possible, and that is the reason why we are looking into these different types of cost: average cost, variable cost, average variable cost, average fixed cost, marginal cost. These are different costs that the firms will look into so they can reduce their costs as much as possible. They also want to generate as much profit as possible. That is their ultimate goal. They want to make more money. That's why they are in the market selling goods and services. So in the short run, a firm will always compare, or a business will always compare a marginal revenue to the marginal cost in order to maximize profit. Okay. In the case or in the scenario where the extra benefit that the producer or the seller gets from selling a product is greater than the extra cost of producing that unit, the business will still continue to expand production and profit will increase. So if MR is greater than MC, firms will expand production and profit will rise. If MR, or if marginal revenue is less than marginal cost, so now the extra revenue they're generating from each output is less than the extra cost they're incurring, they are incurring losses in this case, so they will reduce or cut down their production so they can lower their losses. In the case where the marginal revenue is equal to the marginal cost, the extra revenue earned is equal to the extra cost they are incurring. If they are equal, then that is the level of production where profit is maximized, and that is the point where they will stop. That is their idle point scenario, or the profit maximizing point. So let's look into a graph where if you look at the bottom of the slide, it says graph showing a profit maximizing point. I want to show how, I want to draw a graph and show how businesses can use the different types of marginal cost and average total cost curve and marginal revenue curve to find out their total profit that they're going to make. Okay, so let's say we have this graph. Okay, this is quantity, this is cost slash price. So again, remember demand curve is downward sloping and the marginal revenue curve is twice the demand curve. Then we have the marginal cost curve that's like this. And then we have the average variable cost curve or average total cost curve, which is a U-shaped curve. Okay. Now, based on this, let me show you how we calculate the revenue. Okay. So let's say this, at this level, we have 10 units of output, and then here is $5. The cost. Okay, that's the cost here. But so remember, we're going to start at a point because firms want to maximize their profit. So we're going to start at a point where MR is equal to MC, right? So if you see your MR curve, this is your MR curve, it intersects the MC curve at this point. So we start here and then we're going to go up and go up until it hits the demand curve and then find out the price from that point. At that point, let's say the price is given to be $10. Okay, so we start at the point where MR is equal to MC, go up and find the price. So now we know the price, we know the output. So your revenue is you're selling 10 units at $10 each. So your revenue is $100. Now what's your total cost? Remember, your average total cost is also at the point where the marginal cost is intersecting MR. So we are going to take the cost at that point, and at that point the cost is $5. So total cost is 5 times the, again you're producing 10 units, so 50. What's your profit? Profit is basically your revenue minus cost, which is also $50. And this $50 by this shaded area of the rectangle. This is $50, and that's the profit. So that's how we're going to calculate the profit of a farm using the different types of curves, which is very important. Okay, so moving on, we're going to look into long run cost and profits. So in accounting and in economics, we define profit differently because we look at cost also differently. Accountants will only consider explicit costs when we are calculating profit. Okay, so explicit costs are actual out of pocket expenses incurred by the firm plus your depreciation expenses. So actual out of pocket expenses would be like rent, electricity, salary, insurance, property tax. These are actual expenses that are incurred, and they are called explicit costs, and they are only accounted for in the calculation of profit in accounting. Whereas, in accounting profit, accounting profit is calculated by total revenue minus explicit cost minus depreciation. Okay. On the other hand, economics or economists will consider both implicit cost and explicit cost. Explicit costs are again your actual out of pocket expenses, but implicit cost is basically your opportunity cost. If you would have invested that money somewhere else, what would have you earned? And you're giving up that benefit, right? So, what is that implicit cost? That is also taken into consideration. So, implicit costs are not money payments, but they're opportunity cost of the owner's use of his or her time, talent, asset, and effort. So if I'm trying to produce cell phones, that's the time I'm giving it there. I could have used this time to invest in the stock market and earn some income. So that is my opportunity cost. The income that I could have got from the stock market is something that I gave up because I'm producing cell phones. So that's my opportunity cost. So economic profit is given by total revenue minus your explicit cost minus depreciation minus your implicit cost. And implicit cost is also known as your normal profit. Normal profit is when the value of economic profit is equals to zero. So we are gonna do a quick example to show how we do this. Okay, so let's go to this example. Assume we are starting a new business, or assume we started a new landscaping business. Okay, so that's an example we're taking. We started a new landscaping business last year, and it took me 100,000 to start this business. 100,000 was needed to buy machines. 100,000 was needed to do advertising, to hire some landscaping, to hire some people or workers for my business. So it took me 100,000 initially to start my business. Now, once I started my business last year, I was able to generate $100,000, and the total cost that I incurred over the whole year for my business was $60,000. Right now, we are also given with the information that if I did not invest this 100,000 in the landscaping business, I could have invested it in the stock market or somewhere else and could have earned 20% profit or 20% return on this 100,000. So that is my opportunity cost that I did not get. So first of all, let's try to calculate what is my opportunity cost. So my opportunity cost that I could have earned if I did not start the landscaping business was 25% of 100,000. That is basically 20,000. Okay, and that is my implicit cost. Okay, so this is also known as my implicit cost. Now, I think in the question we're asking what is our accounting profit. So remember, accounting profit is basically given by your total revenue minus your explicit cost. So your total revenue is 100,000 minus your explicit cost is 60,000. These are all your operating costs: rent, labor, then advertising, insurance. All these costs are explicit costs, out of pocket expenses. So that gives you an accounting profit of $40,000 last year that I earned. Now, the second question I asked is what is your economic profit? Remember, economic profit is your total revenue, which is 100,000 minus your explicit cost, here we don't have depreciation, so we're not taking depreciation into account, minus your implicit cost, which is your opportunity cost, and that's 20,000. So your economic profit is basically 100,000 minus 60,000, which is 40,000, minus 20,000. So your economic profit is 20,000. So that's how we're going to look at profit differently between accounting and economics. In economics, we look into the benefit that we give up for the next best alternative, which is the opportunity cost, or also known as the implicit cost. And we'll take that into consideration when we are calculating economic profit. So if your economic profit is greater than zero, then the owner or the business will expand their productions, right? That means you're making money, customers like the product, and they're willing to pay more for it. So they will produce more and sell more in the market, and the business will expand its operation. Okay. Now, if the economic profit for the business is equals to zero, then owner will just continue operation as is, like at whatever level of output they will be at that point. They are earning a normal profit because they are covering all the out of pocket expenses. In addition, they are also covering the implicit cost. So owner is receiving exactly the minimum return necessary to continue and operate the business. So they will not expand their business, but they will continue operating at that particular point. Now, if economic profit is less than zero, then at that point the business will consider closing down, because right now they're making losses. Their explicit and implicit costs are greater than the revenue they're generating. So owner is no longer receiving the normal profit. Customers no longer want to pay the price to um, you know pay the high price enough to cover all their costs. So owner has no incentive. They cut back production or they exit the industry. So in competitive industries, economic profits and economic losses will not persist until they ultimately return to where economic profits equals to zero. So in the long run, in a free market economy, businesses, the industry as a whole, will come back to normal profit. Industry expansions happens when customers like the product and they pay more than the cost of the products to bring it into the market. Firms enjoy economic profit as the revenue they're receiving is greater than the average total cost, so they start expanding. And looking at these, new firms will also start entering the industry because they see, oh, the others are making money, I can also go in and start making money. So when they enter, there will be more competition, and as a result there will be more output. So to sell more output, prices will decrease, and this will go on until the economic profit comes down to normal profit or equals to zero, which is the minimum level needed to sustain in the market. On the other hand, in case of industry decline, where customers no longer like the product and businesses are making losses, customers do not pay prices high enough to cover the cost. So what they will do, they will shut down their production or cut down their production. So supply will go down. Some of the firms will exit the market. So output will fall, prices will go up, and as a result, the market will come back to equilibrium. So under a break-even analysis, we will estimate the price at which you sell the product. So to look at the break-even analysis, we will first look into the price that is paid. Then we make a list of all the variable outputs and find out the average variable cost per unit. Then we compare the price to the average variable cost. And then we will also add up the fixed cost to get the total fixed cost. Okay, we also divide fixed costs by the contribution. This determines the quantity you need to sell to pay all variable costs and all fixed costs. This is the break-even quantity. So this is how we will do the break-even analysis. Again, we will look into the profit, which is total revenue minus total cost. If that is equals to zero, we are at break-even point. Further breaking it down, we know total revenue is price times quantity, and then total cost is fixed cost plus variable cost. So that's the second line. We broken it down, price times quantity minus fixed cost plus variable cost. Then we are breaking the variable cost further down, which is price times quantity minus fixed cost minus average variable cost times Q is equals to zero. So we solve for the break-even point, and that is given by fixed cost divided by price minus average variable cost. Another type of costs that firms look into are called sunk costs. So these are expenses that have been paid by the businesses in order to produce goods and services, but they cannot be recovered by the uh, businesses. Okay, so owners should not include these costs in making a decisions because they already know these costs have been incurred and they cannot be recovered. So there's no point including these costs in your profit making decision or output making decisions. Okay, so an example would be, let's say owner is trying to decide whether to replace a truck or not. So he paid 5,000 for his or her old truck 3 years ago, and it has little to no trade-in value right now. So if he decides to buy a new truck or decides not to buy a new truck, that is his decision. That 5,000 has already been paid, and this old truck does not have any trade-in value. So whether he will buy a new truck or not, this 5,000 should not play any important role because he already paid it. It's gone. He cannot recover it by buying a new car or new truck. So this $5,000 is not recoverable and not relevant to the decision making. So it is known as sunk cost. An owner should only consider relevant costs and relevant benefits when making decisions. We're going to look into the different types of market structures or industries that that can be the characteristics of an industry. Okay, so market structure basically refers to the characteristics of an industry. So in a free market economy, there can be four different types of market structure: perfect competition, monopolistic competition, oligopoly, and monopoly. Now, do not confuse monopoly with monopolistic competition. They are completely two different types of market structure, and I'm going to go over each of them so it's very clear to you guys. Okay, so first we are going to talk about perfect competition. Perfect competition is a type of market structure which has the following characteristics. It has many small firms or many producers. There are a large number of producers in the market. Okay, hundreds or thousands of producers in the market. There are many buyers in this type of market. So again, hundreds and thousands of buyers in the market. Now, the products that the hundreds and thousands of sellers or businesses are making, they're exactly identical to one another, or also known as homogeneous. It is also easy to enter and exit this type of industry. The barriers to enter is very low, so you do not need a lot of, you know, investments or infrastructure to get into this type of business. Also, you can exit this type of industry anytime you want, so it's relatively easy. Now, each firm is relatively small compared to the entire market or industry, and therefore they are price takers. They do not have, the businesses do not have control over the price because they are very insignificant compared to the whole market. Okay, the only decision the sellers can make is how much to produce and use the profit maximizing tools. Okay, an example of perfect competition would be an agricultural market, right? Think about a cabbage market. If I'm a farmer producing cabbage and John is also another farmer producing cabbage, we are going to have identical. These cabbages are going to have the same type of taste. They're not going to be different, right? So again, in the farmers market, there are a large number of farmers bringing in cabbage. So there's large number of sellers. There's a large number of people who are going to buy cabbage because it is part of their diet and they buy to eat vegetables, right? So large number of buyers. The cabbages are identical to one another that the sellers are producing. It's also very easy to enter this type of market, right? If I want to grow cabbage in my backyard tomorrow and start growing cabbage and sell it in the market, I can easily do that. It does not require a lot of investments. Same way, if I want to leave the industry, I don't want to produce cabbage anymore and want to get out of the industry, there are no restrictions. I can just get out of it. So an agricultural market is a perfect example of perfect competition market structure. The second, we have monopolistic competition. Monopolistic competition is also similar, but a little bit different than perfect competition. So the characteristics of monopolistic competition are there are a large number of competitive firms. So again, there's a large number of competitive firms. There's a large number of buyers in the market. It's also relatively easy to enter and exit this type of industry. The only difference between perfect competition and this type of monopolistic competition is these products are differentiated. They're not identical to one another. So what I am selling is differentiated than what John is selling or what Sam is selling. Each of our items are differentiated, which gives us an added benefit. Okay, so each firm or each business will constantly modify his or her product to make it more appealing to the customers. So they So the sellers or the businesses will compete with one another based on quality and the different features rather than price. So as competition increases, a firm may, so if there's more competition, a firm may try to add a unique feature to the product so that it attracts the customers. Okay, so that's monopolistic competition. An example would be the restaurant industry. Like if you think in Dallas, there's so many restaurants, so there's a large number of buyers, there's large number of restaurants, a large number of producers. We all go to restaurants to eat dinner or lunch, so there's large number of buyers. It's relatively easy to start a restaurant. Yes, it's a little difficult than perfect competition, but it does not require a whole lot of investment to start a new restaurant. And it's also easy to relatively get out of that type of industry. Now, products are differentiated, right? Even though there are so many restaurants in the Dallas, some of them are fast foods, some of them are Chinese restaurants, some of them are Mexican, some of them are Thai restaurants. So they're differentiated and they add different features. Sometimes they will say, bento box food is available. Sometimes they will say happy hours. These are all features they add to attract customers and they compete with one another. So that's an example of monopolistic competition. The third type of structure or market structure is called oligopoly. Now, oligopoly has the following types of characteristics. The characteristics of oligopoly are there are few firms, few large, but only 8 or 9 or 10 producers in the market, or 10 or 12 producers in the market, businesses in the market dominating the industry. Again, there's many buyers, a lot of buyers in the market or in this type of market structure. Now the sellers have significant price setting power. They can control the prices because buyers have limited choices. They only have few firms to go or choose between, or among the different types of different businesses. So that's why they have price setting power. Barriers to entry is also very high. Okay, and there's high startup cost in this type of industry, so it takes a lot of infrastructure, a lot of investment and capital to start this type of business. So that's why barriers to entry is high. Also, the existing businesses make it very difficult for new firms to enter in this type of industry because they don't want competition. They are in a very good situation, they don't want any new competition, and they would strategically take business decisions so that new competitors cannot enter the market in this type of market structure. So example of oligopoly market structure would be the automobile industry or the airline industry or the cell phone industry. Okay, most large brand name producers are members of oligopoly. Now, firms in a particular market or industry have a market share that they are very protective about. For instance, in the beverage industry, Coca-Cola has 50% of the sales, and PepsiCo has 35% of the sales, and Dr. Pepper has 10% of the sales. So if a firm loses a market share, that means one of the other competitors has gained market share. So no firm wants that to happen. So if, let's say, Dr. Pepper loses 5% of its market share, it will probably go to Coca-Cola or PepsiCo, that 5%. So they don't want that to happen. So firms will not take any significant actions to compete with one another. They will have an informal agreement between one another so they do not lose any market share between one another. Now, in oligopoly, we also have another ratio or a measure. Basically, this is a technique used to find out the largest market shareholders of the oligopoly industry. So if we have 10 to 12 businesses operating in a market, the concentration ratio will tell us who are the top 4 firms dominating the industry. That is what the concentration ratio is. So in an oligopoly market industry, out of 10 or 15 suppliers, a concentration ratio will tell us who are the top 4 firms and how much market share they're controlling. So let's do a quick example of this. Let's say we're given with airline industry, which is an oligopoly market structure, and we have all these different airlines. United Airlines controls 17% of the market share. Southwest will controls 29% of the market share. Spirit controls 8%. American Airlines, which is AA, controls 21%. Delta controls 15%. JetBlue 3%, and other airlines. We have other airlines like Frontier, and then some other local airlines which control 7%. So based on this, what is the concentration ratio? Remember again, concentration ratio is the top four firms. So top four firms here is American Airlines, 21, Southwest Airlines 29%, Delta 15%, and United 17%. So we will take 29% plus 21% plus 17%, which are the top four numbers, right? Plus 15%. And if we compute that, we end up with 82%. What this number tells us is this four firms, United, Southwest, American, and Delta, these four firms alone control 82% of the airline market or airline industry. And that is what the concentration ratio tells us. So hope that is clear to you guys. Next, the last type of market structure we move on to is called monopoly. Okay, monopoly has the following characteristics. There is only one single seller or one single business in the industry. So there is only one producer in this type of industry who's producing all the goods and services. No other competition or no other firms are there. The barriers to enter to market is very high. Okay, nobody can easily enter this market, or it's very difficult to enter this type of market. One firm controls the entire supply of the industry. Again, there's a large number of buyers. It will charge the profit maximizing price and not a higher price, because profits will be lower as demand is a downward sloping curve. Again, barriers to entry can include a patent, a government license, franchising requirements, government regulation, or high startup costs. Examples of monopoly would be electric farm in a certain area or some pharmaceutical companies. For instance, in McKinney, where I live, the only electricity provider is GoServe. Even if I want, I cannot have another service provider for electricity. So GoServe is a monopoly. It is the only supplier of electricity in the area. So they will be the dominant firm or controlling 100% of the industry. In terms of efficiency, monopoly is least efficient. Perfect competition is most efficient. So perfect competition is the most ideal case scenario. So in the short run, at least one of the resources or input is fixed, but in the long run, all the resources are variable or can be increased or decreased. Okay. So fixed input is usually the physical capacity of the farm, the size of the facility, the amount of input, equipment. These are examples of fixed input. Since capacity is fixed in the short run, farms experience a diminishing marginal return because they cannot increase the number of equipment. When they start producing more and more, in the short run, they will experience diminishing marginal returns. So farms will have to make daily decisions on how much to produce in the short run and how they can maximize profit. In the long run, farms can acquire more equipment to produce more output, so they can vary the input and as a result enjoy economies of scale. So that takes us to economies of scale. What is an economies of scale? Economies of scale refers to the decrease in average total cost as the capacity to produce increases. So what happens is as we produce more and more output in the long run, the total average total cost decreases, which means the farm will enjoy economies of scale because the average total cost decreases, their profit will go up because they are going to be making more money now. So farms can achieve this by switching from batch mode operations to assembly mode. This is an example how they can achieve economies of scale. Like in batch mode, we would like in the car industry we had batch mode before. We would focus on one car and everybody would be working on one car at one time, and then once that's finished they will move on to the second car. But then now the car industry has moved to a assembly mode operation, which means let's say when someone is painting the car, if they're painting all the different cars, like the 10 or 12 cars at the same time. So when someone is putting wheels, they're putting 10 or 12 wheels all at the same time. So the work is specialized and divided based on the type of work, and that's how they can achieve lower the cost and achieve economies of scale. Supermarkets replace the mom and pop grocery stores because of economies of scales, right? Because they were able to provide groceries at low prices due to economies of scales. Consumers have an arranged layout of products in the store, right? Consumers on the top, you will see where you can find cereal, where you can find oil, where you can find drinks. So these are all arranged in a proper layout. And then employers are also specialized in these supermarkets. You know, the checkout, the people in the register, they are experienced in handling cash and checking out customers. Then people who are in the inventory sections, they are specialized and experienced in organizing and accounting inventory. And the bakery section, we have like, you know, bakers. In the meat section, we have like butchers. So everyone is specialized, and that help them to lower the cost and enjoy economies of scale. The opposite is also true, which is known as the diseconomies of scale. So this happens when a firm reaches a particular size, the average total cost will start increasing, which will cause the diseconomies of scale. So if the firm starts if the capacity of the firm is fixed and they start increasing their output, at one point they will experience these economies of scale because the acquisition cost will be going up. This is because if the facility is too large and there's only one manager to take care of the facility, this will cause these economies of scale. They will probably have to appoint an assistant manager or another manager to take care of the cost. This is an example. So these economies of scales is not a good thing. It's bad. The firms want to avoid that. Now, different industries will have different shapes of average total cost curve because the economies of scale and these economies of scales varies based on the type of industry. If it is a grocery store, the average total cost curve decrease will be smaller. But if it is a bigger in operation, like such as a cell phone business, then the average total cost curve decrease will be over a longer out. So that is lecture 4 that takes care of this lecture. So in the next class, we are going to look into lecture 5, or in the next video, we're going to cover lecture 5. But we have looked into the business side and the different types of market structure in the industry. Thank you very much.